Watch this entire video straight through. It runs 10 to 12 minutes, and every section builds on the last. Take it in order, start to finish. If you skip around, you will get an incomplete picture, and you will misread what the market is actually pricing. Stay to the end, and you will understand the signal, not just the headline. In the last video, I said the line in the sand was $4,980 on spot gold, and I gave you the reason. That was the level where liquidity kept reloading and where sellers were getting absorbed. I also said that if $4,980 held on an hourly body close, the next magnet was $5,080 because the short side would have to chase or cover into thin offers. That is exactly what played out. Price tagged 4,184, held that zone for 37 minutes, and then the next impulse did not stop until $5,081. The timestamp proof is there and can be verified. If you are new here, go check the prior upload and the timestamp proof. Don't trust me on this, verify it yourself. Now let's get into what is happening today. Today, gold printed $5,107 per ounce during the Iran war shock, and it was not a gentle grind. Reuters documented that tokenized gold kept trading while legacy exchanges were closed, with Pax Gold marked at $5,144 per ounce, up 2.2% since Friday, and Tether Gold at $5,292, up 1.2% since Friday. When the main venues reopened, that bid spilled into Western paper first and then into the broader spot complex, with dealers repricing in real time as spreads widened. At the same time, China has its own physical reference points, with the Shanghai gold benchmark auctioning at 10:15 and 14:15 Beijing time, and the Shanghai Gold Exchange physical proxy AU9999 printing record sessions with double-digit tonnage turnover. So you have a war catalyst, a weekend proxy premium, and an East-led physical signal all landing on the same tape. The question is what forced the acceleration right there. On the surface, this move makes no sense, and that is where most commentary dies. Normal textbook logic says a war spike should lift the dollar, lift real yields, and pressure a non-yielding asset like gold. And parts of that happened. The dollar firmed and the bond market sold off as inflation risk got repriced through oil. Yet gold still caught the bid. That is the paradox that matters. In stress regimes, gold trades less like a commodity and more like balance sheet insurance. People buy it not for yield, but to exit counterparty chains. That is a Minsky-style moment, when stability flips into fragility and the market starts paying for certainty. If you understand that, today's action stops looking random. Here is the part you will not hear on mainstream financial media. The East versus West gap is the tell for who is setting the marginal price. When Shanghai is paying a premium, it is a direct vote for physical demand, not just futures leverage. In late January, AU99999 traded 16.0 tons, and then 16.3 tons on back-to-back sessions, while the onshore basis held a premium of 0.1% to 0.2% over London, a small number that carries huge information. The LBMA's own Alchemist report documented an even sharper divergence at one point, with the SGE premium over London spot hitting $128 per ounce, and later still around $89. Now add inventory behavior. Improved reported the Shanghai linked vault buffer moving to roughly 102 tons after adding 1.87 tons in a single day. When Asia pays up and holds inventory, it means metal is being pulled through the pipeline, and Western price discovery eventually has to follow, or the flow will drain. That matters, and that divergence is not accidental. Now layer in macro and geopolitics, because gold is reacting to more than fear. First, the catalyst is the US and Israeli strikes on Iran, and the market immediately starts mapping second-order effects like shipping risk, refinery risk, and the probability of disruption in the Strait of Hormuz complex. Reuters captured the blunt version from Edward Meir at Marex, quote, "You are going to see a knee-jerk spike up in most commodity markets, including gold and oil," end quote. Second, the policy channel matters. Bloomberg reported that President Donald Trump said the U.S. would keep its military offensive against Iran for as long as it takes, and that kind of open-ended posture changes how traders price duration risk. War risk hits oil. Oil lifts inflation expectations. Inflation expectations pull rate cut pricing back, which tightens conditions and stresses the bond market. Then the market does what it always does in a credibility shock. It reaches for assets without default risk, and gold absorbs that flow. Charles Kindleberger wrote that crises spread when confidence breaks faster than liquidity can be provided, and that is exactly the setup you are watching. Now let's talk about the plumbing. Now the manipulation layer, because price is a product of structure, not purity. The modern gold price is still largely discovered through futures and bank market making, and the documented enforcement record proves that this can be abused, especially in thin hours. The CFTC ordered JP Morgan to pay $920.2 million for spoofing and manipulative conduct spanning at least 8 years, including hundreds of thousands of spoof orders in precious metals and U.S. Treasury futures. The breakdown was $311,737,108 in restitution, $172,734,790 in disgorgement, and $436,431,711 as a civil penalty. The mechanics are straightforward. First, a desk places large orders it intends to cancel to create a false wall of supply or demand. Second, other participants react, spreads shift, and price ticks toward the fake liquidity. Third, the desk fills the real order on the opposite side at a better price, then pulls the spoof orders. The structure is always the same, and it has been verified in regulators' own language, not just allegations. What this means for you is simple. Short-term spikes and dumps are often liquidity engineering layered on top of real fundamentals. Technically, 2 levels matter after the 5,117 print, and I want you thinking in closes, not emotion. Support is $5,040. If we get an hourly body close below $5,040, the market is signaling that the impulse leg is failing, and the unwind target becomes $4,180 because that is where absorption was previously documented. Resistance is $5,195. If we get an hourly body close above $5,095, that is continuation confirmation, and it typically forces dealers to re-hedge upside exposure, which can extend the move. On the hourly chart, the 150 EMA is a key reference for trend participants. Price can be bullish and still mean revert hard back toward that average after a shock burst. This is educational only, not financial advice, and the point is to read structure, not chase candles. Now the resistance case, because intellectual honesty requires this. The honest read is that war bids can fade fast once the first wave of fear is priced and liquidity normalizes. Risk 1 is a ceasefire headline that hits during thin hours, collapses oil, and drains safe haven flow out of gold in a single session. Risk 2 is a sustained dollar uptrend if the Federal Reserve turns more hawkish on inflation, because a firmer dollar can pressure gold even with geopolitical risk. Risk 3 is market plumbing. Exchanges can raise margins, funds can de-risk, and you can get forced liquidation that looks like fundamentals but is really positioning. Also, China premium data can be distorted by import policy and currency defense, so it is not a pure demand gauge every day. Respect the two-sided risk. But here is what did not change. Central banks are still diversifying reserves, and that is a structural bid that does not care about today's headline cycle. The East-West pricing gap still matters. When Shanghai pays a premium, it is a real-time vote for metal, not paper, and it is one of the best tells of persistent physical demand. Inventory and custody data remain the scoreboard, including the Shanghai vault buffer moving past 100 tons, and the fact that London vault stocks can rise even as Asia bids for immediacy. The documented spoofing history also did not disappear, which is why you interpret intraday swings through liquidity, not morality. And geopolitical duration risk is still elevated, which keeps the insurance motive alive. Watch inventories and premiums, not just price, and monitor whether the premium holds through pullbacks. For real-time updates, follow the only official handle, Metals Logic on X, because that is where I post levels and source links as the tape moves. If conditions change fast, you will see it there first. Thank you for spending these minutes with me. I will keep it data-driven, verified where possible, and allergic to narrative theater. Invest with logic, not hype.